Okay, students, welcome back to my channel. Today we are going to discuss about types of insurance. First categorization of insurance is into life insurance and general insurance. Now, many times we feel that life insurance is all about human life and general insurance is about non-life. But this is not the right definition of differentiation. This is not the right differentiation between these two. So the first one, like for example, health insurance. Health insurance is dealing with human life. Now my question is whether the health insurance is life insurance or general insurance. Now many of you may say that as health insurance is dealing with human life, it is life insurance. But this is not the right answer. The correct answer is health insurance is general insurance. Now, how do I justify, how do we differentiate between life and general insurance? The basic differentiation is because of principle of indemnity. Now, what is principle of indemnity? It says that insurance cannot be used for profit making and insurance should be used only for recovering losses. Like for example, motor insurance is general insurance. Now health insurance again is general insurance. Why? Because suppose a person is there. Let us take one example. Mr. X is having insurance from company A and company B for say 2 lakhs and 2 lakhs. Now Mr. X is hospitalized and he gets a claim of 2 lakhs. Health claim. He is not well. He is in the hospital. So health claim. Hospitalization claim. Now this health claim of 2 lakhs. Now should he take from company A or should he recover from company B? Or can he recover from company A and B both? If he recovers from both the companies this claim, then 2 lakhs is his cost and another 2 lakhs is his profit because it is beyond the loss. Now beyond the loss, if he is able to make profit out of it, it is not allowed in insurance. And principle of indemnity says that the claim cannot exceed the losses. So because health insurance follows this principle of indemnity, health insurance will be termed in general insurance. So as I had told you before that whether health insurance is life insurance or general insurance. So now we can easily say that health insurance is a general insurance and not life insurance. Because why? Because health insurance follows principle of indemnity. Any insurance which follows principle of indemnity will be categorized into general insurance. So I think this is very clear. Now let us see the categorization of life insurance. Now life insurance can be categorized into traditional and non-traditional policies. What is traditional policies of life insurance? Those policies, traditional policies are those policies which are participating in the profits of the organization, or they are also called as participating policies. Other policy is non-traditional policies. Non-traditional policies like, for example, unit linked insurance plan, ULIP, which are investing your money in the share market, but they do not have any rights or they do not participate in the profits generated by the insurance company. What are the profits of insurance company? Insurance company has some expenses like claims, administration, expenses. All these expenses, total expenses, when subtracted from the premium is the revenue for the organization. From premium, claim, expenses, salaries, office expense, everything is subtracted. After that, some profit is generated. That profit which is left is given to the participating policies at the end of the maturity. So the bone as a part of bonus, like a bonus. So that is bonus is part of profit. So in traditional, bonus is shared, but in non-traditional, bonus is not shared. Whether there is profit or loss, nothing to do with that in ULIPs. But unit link insurance plan, the money is invested in the stock market, share market. Share market, if it becomes zero, if share market becomes zero, then there can be losses also. There can be zero profit also. In traditional policies, participating policies, if there is a profit, it will be given as a bonus. If there is no profit, there will be no bonus. Traditional policies are less riskier. ULIP policies are more riskier. And more the risk, more the profit, more the returns. Lesser the risk, lesser is the return. So this is traditional and non-traditional, participating and non-participating. This is one categorization of life insurance. Another categorizations of life insurance, let us understand. First one is term plan. What is term plan? Okay, let me make some small sheet so that you can understand in one perspective. After that, I will explain one by one. Term plan, then endowment plan, then money back plan, then pension, annuity plan, then whole life plan, then Keyman Insurance. These are the major plans. So, what is term plan? Term plan is this: if for a particular term, 5 years, 10 years, 15 years, if the person dies in between this particular term, death claim is given. But if the person does not die in this particular 5 years or 10 years term, whatever is the term, there is no survival claim. Survival claim maturity is not there in term plan. Because the benefit is only because of death, term plan is very cheap or less priced, low priced. Now people started saying that why this term plan, there is no benefit for survival. So they wanted something better than this. So the another plan was made, that is endowment plan. What is endowment plan? For a particular term, say 5 years, 10 years, for 5 years, for 10 years, if the person dies in between, he will get a fixed sum assured. Fixed sum assured. And if he survives, there will be a maturity claim, survival claim at the end of the tenure. And so this kind of plan is good for, say, planning for marriage, education of child. So such kind of things is good for this plan. This plan is good, but it is costlier than term plan. If you have very less money, what you will do? Endowment or term? At least you can take term plan and cover yourself. But you have some better budget, you have more price, you have more premium, then what you will do? You can take endowment plan. You can plan for your child's marriage, education, your retirement. So such kind of planning can be done with this particular plan. But it is costlier than term plan. So let us see the other ones. Okay, now we are going to talk about money back plan. It's extension of endowment plan. So money back plan is a plan for a particular time, say 20 years. Every 5 years, say 10% will be given back. Why such kind of plan was made? People start complaining about endowment plan that at the end of the tenure we are getting liquidity if we are surviving. But people want liquidity in between. So this particular plan will give some part of money in between, and in the end maturity will be given. So this gives more liquidity. Benefit is more, so premium definitely will be more than the previous insurance. So this is money back plan. Then the next one is whole life plan. Whole life plan. Okay, in endowment plan, suppose you have taken a plan for 20 years. Suppose you are, say, 40 years now. Let us assume. So at the end of 20 years, you will be 60 years. At 60 years, no insurance company will give you life insurance, or they will give you at a very higher premium, because higher the age, higher is your mortality rate, chance of dying. So if the chance of death is more, definitely the risk for the insurance company is more. So if the risk is more, the insurance company will ask for more premium, because chances of claim is high. Or they may not give you also, because at 60 years you may be having some diseases, and they may do not want to take such risk. So to take care of this problem, whole life plan was made. Whole life plan is what? Until your death you are covered. 100 years tenure or more than that, till you survive. So whole life plan is also called as your will, because claim will 100% come. You will die one day. You means the customer, the insured. So when he dies, his beneficiaries, his nominee will get the sum assured. So whole life plan is also called as will. It's a short claim. And what do you think? Whole life plan is the costliest plan amongst all till now. Costliest, because claim is 100% to be given to the beneficiaries. So this is the idea about whole life plan. Now let us see the other ones. So term is understood lowest premium. Endowment plan is for marriage, for education, mature life, survival benefit is there. Money back is better liquidity. Whole life plan is for 100%, 100 years or more, complete lifespan. There is a 100% claim. And now we are going to talk about pension or annuity plan. So pension or annuity, or pension means what risk it covers. The risk which it covers is risk of living too long. Now because of medical facilities, for better health facilities, individuals are living longer life. After retirement also they are living quite a long life. That is called as risk of living too long, because your income will stop at a later stage, but your life is continuing. You are retired. So that is risk of living too long. To cover this risk, pension plan is made. Pension plan means when you are working, you can save some money to the given to the insurance company. After retirement, the insurance company will give you some fixed amount as a pension, as an annuity, annual amount, to continue your life in a same way as you were doing when you were working. So if suppose you are saving some money and giving to the pension company when you are working, after retirement, the insurance company will give you some fixed amount, or even it is flexible is also there, 5% increment as per inflation, 5 or 8%. So that any other such kind of plans will be given to you, so that you can survive after retirement. You are not getting salary, but the pension you are getting, that is salary is given by the insurance company as a pension to take care of your needs. That is pension plan. Another plan which is very interesting is key man insurance. So who is the key man? Key man is a person without whom the organization will have huge losses, because he is the key person to make decisions. So such kind of person, if he is not there in the organization, he will definitely, the company will face losses in his absence. So such person if he will be given a key man insurance, and if he dies, a compensation is given to the uh, organization. So that is key man insurance, which is most important person in terms of running the business. And if he is not there, the insurance company will give money to the company for the loss of this key man, to compensate the loss in the business because of absence of this key man. Key means important person. So these are the major or most important uh, life insurance types, which I hope you have understood. Now I would like to talk about some general insurance. So general insurance can be categorized again into, say, the first one is motor insurance, car insurance, vehicle insurance, same thing. It is mandatory for, in most of the countries, it is mandatory for us to insure the car when it comes out of the dealership. New car has to be insured when it touches the road from the dealer. So that is motor insurance. Motor insurance is required for any accident happens, any theft happens of the car, or a third party claim comes in the motor. It can be commercial, it can be private. That is motor insurance. Second insurance in general insurance is, say, fire, earthquake, theft. Generally done for house or for the factories. Fire insurance can be done for the house, fire, earthquake, theft, structure, plus the material inside the house is also covered. So fire means the building, if it catches fire, then fire insurance is required to recover the cost. Earthquake, flood comes and the property is destroyed, this insurance can cover it. Theft in the house, this insurance can cover it. So structure means the structure of the building, if it is destroyed, and anything inside the house in the building can also be covered in the insurance. So these are types of general insurance, all of them. Then liability insurance. Liability, director's liability, we say, or professional indemnity policies. That means if the doctor has done some mistake by chance and the patient sues him, then the professional liability is there towards the customer. So that customer may ask for claim from the, for because of doctor's negligence, something happens to the patient. So such kind of, if policy is there, doctor does not has to pay from his pocket, but the insurance company will pay. But the mistake should not be there of the doctor. Negligence should not be proven. So liability insurance, director's liability, that is director does some mistake and the organization suffers. So director's liability insurance is there. Any liability. is covered in this particular insurance. Next is marine insurance. MARINE, marine. So marine insurance is inland marine insurance. Another is hull insurance. What is hull? This is the ship. This is the ship. This is the ocean. The part of the ship which is in the ocean is called hull. And when there is an accident, this area will be destroyed first. That's why it's called a hull insurance in the sea. Marine is sea. What is inland? If the truck is going and meets an accident and your goods are destroyed, that is inland, marine inland insurance. So two types, on the road, in the ocean. So this is marine insurance. That is also general insurance. Now another insurances are also there, like for example erection all risk, CAR, construction all risk. Like if there is a project going on and there is some accidents, there is some delay, there is some problem in the project, such risks are covered with EAR and CAR policies. Another is also there. Now there are so many, so let me change the slide. Another would be workman compensation policy. What is workman compensation policy? If the labor is working in a project and he suffers, suppose he meets with an accident and his arm is cut, or by mistake he dies or something happens, the family will claim from the management a huge amount, and this claim comes from the labor court. There is a court, workman compensation court is there, and that court can compensate at any amount. It can be huge amount also, and that money has to be paid by the management. But if you have workman's compensation policy, management is out of that claim and the policy will pay the claim. So workman compensation policy is mandatory for most of the places where there is a labor working. It's very important. Sometimes because of workman compensation policy problem, if it's not there, companies are sold because of claims come very huge. So workman compensation policy again is very critical, and it is required for paying the laborers if there is an accident. So now let us see what is left. Okay, fine. I think most of the things are covered by this. Maybe some things are left. Whatever I can remember, I have told you. If anything I have left, if you want to understand some policy which I have left, you can comment. You can definitely tell me. I can make another video on that. But these are most of them are major ones. These are the major policies in general insurance. And now I'm going to talk about in the next videos. Also, please like or subscribe my channel if you have seen till now. Now in the next video I am going to talk about some principles of insurance and some basic concepts like pooling of risk and like principle of indemnity in little more details, utmost good faith, then principle of proximity. So many principles are there, which all the principles I will cover. 6-7 principles are there, and insurable interest. So basic fundamental concepts I'm going to cover in that. And also, if you don't know about my channel, I'm always coming up with management concepts. It can in the future I'm going to make it on project management, operation research, and research concepts. Already I have made some on motivation and leadership theories. So such topics I'm going to cover in future. If you are interested to get the latest, you can definitely enroll my channel, and I will be happy to help you. So these are the things which I wanted to cover today. That's all about. Thank you very much. Have a nice day. So the finally we can say the conclusion that life insurance does not follow principle of indemnity. So let us again I will say that, for example, if there is a term plan of say 10 lakhs and the person dies, natural death also, or anything, he died in his house without any expense, then insurance company cannot say that because there was no loss, so or the loss is only 1 lakh, we will not pay 20 lakhs sum assured, the contracted amount. Life insurance cannot say this because life insurance does not follow principle of indemnity. But in general insurance, it is not like this. In general insurance follows principle of indemnity. If there is motor insurance, only the damage of the car will be given to the insured, not the whole cost. More than the loss will not be given, because principle of indemnity is followed in general insurance. House insurance, earthquake comes or fire is there in the house, the total amount which is required to construct the house, reconstruct the house is completely destroyed because of flood or earthquake or a fire. So the market value of the house is say 1 crore, 1 crore or $1 million, but the cost of construction is 50 million only. So only 50 million will be given by the house insurance, not 1 million. 1 million is the profit, the market price, that is with profit. That will not be given in house insurance because it is a general insurance. So only the cost for reconstructing the house and recovering your loss will be given. Similarly, whatever general insurance I told you previously, all follow principle of indemnity. If they don't follow principle of indemnity, they cannot be general insurance. But in life insurance, principle of indemnity is not followed. Whatever is the contracted amount, like sum assured 2 lakhs, 10 lakhs, and in the death nothing happened, no expense happened for the family, still the insurance company cannot deny the claim because there is no principle of indemnity, and whatever is the amount for which you have paid the premium will be given to you without any questions. So these two difference between life insurance and general insurance should be clear to the students. Sometimes there's a lot of confusion. General definitions are not good. Technically we have to speak what is the difference between life and general. Now also I am going to talk about various principles later. Thank you very much.